Hi guys. I'm going to talk about something more simple today. If you are still confused, probably this is my department that we can help you. So what do we do, right? Is that I'm from portfolio team. So what it means is that we help you to manage your money. And this is basically a summary of a summary to simplify for this session, right? Is that you look at the first point, we actually decide. So you need to select. We have a few portfolios. You need to select whether you are aggressive or conservative or whatsoever, right? Your risk profile. And what we do here is that we will decide whether we want to increase equities or increase bond exposure for you, right? So this one that you see here is that we've been overweighting equities by 5% since 2 years ago, right? And if you recall 2 years ago, a lot of people have been talking about recession. People scared about recession, right? Even 1 year ago, people were talking about recession, but we were still overweighting equities for one simple reason: is because it's very, very cheap for long-term structural sectors and countries, right? So if you're not able to do that, then probably our department is the best for you, right? And number two, the world is big, right? So if you're still confused about all the countries, all the sectors that were presented, that people talk to you, then we actually do it for you. We decide how many percent to invest in which country, which sectors, whether we need to get out of certain countries. Let's say, for example, China. 2 years ago, we actually been reducing our China exposure, right? So if you're holding a lot of China and you didn't get out of China, then you know what's your position now, right? But we actually did the hard part for you, right? And the third point is that we have so many unit trust funds in the world, in Malaysia, and so many ETF funds, so many ETF in the world, right? So how do you select? We select for you. We have our own in-house process. We select the best of the best, right? So there are a lot of good ETF, good unit trust funds, but among the best, we select the best for you, right? So in conclusion, this is the list, this is the portfolio that we have for you, right? So you have bond funds at the top and equity funds at the bottom. So, and you look at the individual sectors, you have US, Europe, Japan, Asia, Japan, ASEAN, EM, Malaysia, technology, digital economy, tech, supplementary portfolios. At the bottom, global health science. So look at this is 15 to 17 funds and ETF. How are you able to manage and monitor, right? So if you can't do that, our department is the best for you to look into, and our portfolios are the best for you to look into, right? So just to quickly go through what happened in the recent past, what I'm talking here about is 1 to 2 years ago, right? Up until now. So investing is not just about performance, but upside, but also managing your risks, right? So what happened in the past one and a half years is that this is the list of bond funds that got impacted over the past 1 to 2 years, right? I think a lot of people know about Credit Suisse defaulted, Country Garden went into issues. And also there are a lot of issues for a few issuers in Malaysia as well. So a lot of bond funds got impacted. So you might think that, wow, investing in bond fund, what can go wrong? But a lot of things went wrong for the past 1 to 2 years. And I was surprised, our department, our whole team was surprised as well. And we spent so much time in the bond segment, which we shouldn't be, right? So, but we did. And I'm happy to share that if you're investing in our portfolios, you were not impacted by any of this, because either we don't have exposure or we got out before they impair the bond fund, right? So look at the number of bond funds. Basically, a lot of fund houses were involved, right? So how do you track? So we do that for you. I mentioned about this already. So we overweighted equities. We remain overweight equities even when the whole world talking about recession, right? The whole world, very hard to get investors to invest, but we are not just investing, but we overweight equities, right? So how many people can do that, right? And this is on country allocation, sector allocation. How many people can not have so much exposure in China? So we actually underweighted China. We only have like 3.5% on a neutral basis for our China exposure. And we had a lot of exposure in US, 19%. And we overweighted Japan about 1.5 years ago. We continuously increased our exposure. And we even have very sizable exposure in Malaysia, 10%. And I think everybody knows that Malaysia small and mid-cap has done very well, right? So we are very concentrated in Malaysia small and mid-cap because of all the structural trends that we like, right? So all the research that my colleagues presented earlier on, or even before this, all the good stuff are all in this portfolio, right? So we have a specific tech segment, which is 5% in global tech and 5% in semicons. So this is our previous allocation. I'm going to show you our latest changes, right? Yeah, so the next part here I'm going to share is that our universe is not just unit trust, it's also ETF, right? So our universe is so huge. And what we managed to do is that we combine the best of both worlds, unit trust and ETF, into our portfolios, right? So we managed to find very, very good ETF that can substitute unit trust funds. So we now have 3 ETF in our funds, in our portfolio. So US, we have JP Morgan US Quality Factor ETF. Digital economy, we have the PNQI ETF, and then we have Renang Semicon ETF. So 3 ETF. And it's very tough. It's actually very tough to include an ETF because not all ETF can beat unit trust funds, right? So here we go. And this is for Islamic portfolios. So Islamic portfolio is even harder. It's so hard to get a Islamic equity ETF, right? So but one thing that we added recently was this ESG fund. It's not because we want to add an ESG fund, that's why we add it. We add it because it's a good performing fund, right? So everything needs to come from risk and performance. And all the good stuff that I just talked about is all reflected and help us to maintain our long-term performance. So if you look at 2022, of course, everything was down. Our portfolio was down as well. But in 2023 and year to date, we actually recorded double-digit return for our aggressive portfolio. So the key thing is that you need to be down lesser when market is down, and you need to be able, your portfolio entirely need to be up when market is up, global market is up, right? You need to be able to capture the recovery. So we managed to do that. And if you just take a step back, since our inception, our portfolio, we only had 2 down years. And these 2 down years are basically because most of the markets were down, right? So, and the second point I want to point out here is that we actually had more up years than down years, right? So from an investor perspective, what I would think is that I want to invest in something that I'm very comfortable, a team that is constantly positioning for me, a team that constantly investing in global trend and structural trends and global growth for me, right? So then I'm comfortable and I'm confident to invest when market is down. The problem is that when market is down, investors are afraid, right? But you know that it's cheap, but you are afraid, right? So this is actually a good avenue for you to consider. When market is down, what you can do is that you know that our portfolio is very well managed, and when market is down, it gives you confidence to enter the market, and then you subsequently can capture the recovery. So this is how you can enhance your long-term returns. So all this performance here that I'm sharing is not even taking into account of you entering the market almost at the low, right? These are just without any intervention by you, right? So this is our Islamic portfolio. Islamic portfolio, we have a shorter track record. It started in 2019, but it's the same kind of dynamic, which is that we have more up years than down years. So 2022, everybody know it was a down year, right? So but you look at our recovery 2023 and year to date, this is all this data up until June, right? So look at the double-digit returns for aggressive portfolio. Even your conservative portfolio was up 7.9% last year. Year to date is 4%, right? And I'm just going to show you that the key changes for our portfolios, which most investors don't do. Most investors just hold and don't make any changes. Even your advisors like ask you to change, you still be like, let me think about it, right? But in investing, if you need to change, you need to change, right? So that's what we did, right? So what we did was that in December 2022, so it is roughly at the market was still recovering, but more on the lower end side. So at that point in time, we actually made the decision to reduce our China and China tech exposure, and we increased our US, Japan, and Malaysia equity. And last year, we continued to reduce China, we continued to increase Japan, and then we continued to add US, and we actually removed our Hong Kong tech and replaced with global semicon ETF. So the question is that, are you able to do that as an investor, right? Because remember September last year, semicon already up quite a lot, but now it's up even much higher, right? So that's what we do. The reason we make all these changes is because based on our research that tell us that we should actually continue to be on this direction, right? So all these significant changes has actually started since 2 years ago, right? So what are the next changes for us moving forward? Is that we think that we are on the right track and we want to continue on this positioning, and we want to continue to be able help allow our portfolios to capture global growth and structural trend. And for us to do that, we think that it's very important that we change our equity allocation benchmark to allow us to further increase our exposure in developed market, which is mainly your US. So with these changes, this is to show you that the index would have much higher US exposure, much lower China exposure. But bear in mind, our China exposure is already very low to start off with, because we have been doing the changes since quite a while ago, not now, right? We are doing this more on formality and to reinforce our house view. And that is on country basis, this on sector basis. So with these changes, we would have more exposure into technology sector and lesser into financial exposure, right? But if I already presented just now is that we had started these changes since quite a while ago, right? This is not a new thing, right? It just further reinforced our house view. So with these changes, what will happen to our new portfolio, right? Is that you can see that our US exposure is almost double, right? It's now, it will have 36%. And our Japan exposure would slightly increase, 12%. And we have slightly higher Malaysia exposure, 13%. And also we have quite sizable exposure in tech as well, but split into global tech and semicons. The reason for this is that the structural trend for, let's say for those that be overweight, right? Let's say Japan and Malaysia, the structural trends are very, very real and very intact, right? It's structural, right? It's not something it's not one-off, right? So my colleagues has already talked about Japan and Malaysia. So I think I just want to focus a bit on Malaysia as well. Is that if you just think about it, China plus one strategy, businesses are wanting to diversify their operation out of China. Who are the key beneficiaries? Malaysia is one of them, and it's already happening. And our ministers are working very hard, right? So just not read too much on the noises, but read much about what they are doing, what they are bringing to Malaysia. That is exactly what's happening, right? So you can see our small to mid cap stocks are doing very well, not our big cap stocks, right? So, and US exposure, I'm going to talk about it because it's quite sizable as well, 36%. So why US, right, is that if you look at, let's just talk about tech, right? We also have heavy tech, heavy US. If you look at, as an investors, right, you want to invest in a segment, a country that is growing very strongly, that you can see the future, right? That you're using their product and you will be increasingly using their products, right? So that is no other than tech sector, right? So if you want to capture global growth, you cannot not have tech in your portfolio, right? It makes sense, right? So if you look at tech, look at their market shares, search engine, for sure it's your Google. Google is what company is US, but they actually operate globally. If you want to capture global growth, you need to invest in Google, but Google is a US company, right? So that is where there's the line is getting more gray. So it's not about which country you invest in. It's more about which sector, right? What are they doing? And if you look at the cloud infrastructure, everybody talking about cloud, right? If we want to venture into improve in AI, delivering more efficiencies, you need a very strong cloud infrastructure. So globally, Amazon, Microsoft, Google are the key market share companies that they capture the most market shares. So the same thing, if you want to capture global growth, these are the companies, unfortunately or fortunately, right? So don't just too fixated whether it's US or China or whatever. Look at the below the surface what it is, right? So if you agree on tech, if you want to have tech in your portfolios, if you want to have someone to manage your portfolios which have tech, then that is our portfolios. And another thing about US is that US is a market that is very liquid. Companies who want to raise money can be raised much easier than compared to other markets. So this is to show you that the chart here and the table here is to show you that US market is not just for US companies or US citizens, right? Actually, China companies from China is that went to US for listing is the highest, right? Last year, 2023. And if you look at the bottom, the chart here, the number of US IPOs, that is non-US companies listed in US stock exchanges, last year was 53%, which means like almost half is non-US companies, right? Think about that, right? Is US really still purely about US? No. And when we talk about US, we talk about S&P 500 index, right? I think everybody knows. And if you look at S&P 500 index, you look at the revenue. Actually, from a revenue perspective, 64% of revenue is from US. The rest is from out of US, right? So that is how global US companies has become, right? So I need you to switch your mindset to think about global growth, how your portfolios, your wealth can capture global growth. And very short one on China. So we have very low exposure in China, and basically this is very in line with business trend and even the key indexes. So this is a chart to show you that foreign direct investment into China, nobody can disagree, is collapsing, right? The recent numbers, right? This is a fact, okay? So this is a businessman's perspective. So as an investors, should I follow businessman's perspective? Since businessmen are not reducing their investment, I should follow as well, right? You don't go against the flow, right? So that's one thing. The key thing I thought about China plus one. If you really want to invest in China story, that is Malaysia. Because it's China plus one. Malaysia is the plus one, right? So think about it that way. And the second point here is that even MSCI Emerging Market Index, right, index provider, the exposure in China has been decreasing for the past few years. Why are you... We don't want to fight against the flow, right? And the next point here is to show you that just now I started with 3 key points, right? One is country, where do we put our money with which country, right? And then I also talk about we select the best of the best funds. The first point was your equities and bond allocation. So we were very happy for existing clients that managed to ride through with us, and we had overweighted your equities by 5%, right? And up until recently, I think past 2 weeks, we actually started reducing our equity exposure. From our perspective, is that there's no reason for us to continue to keep overweight equities because we already benefited so much, right? And we think it's better for us to be neutral. So this is our neutral allocation, which is back to conservative 10% equities, 10% bonds. So these are the 3 things that we will continuously monitor, right? So this is very important. So how do we keep in touch? One way is we do write articles. So this is the quarterly articles that we write. And we also have monthly articles that we write. Monthly articles are more detailed. So I know everybody would be very busy to read monthly articles. So this is the quarterly article that we have. And if you are still very busy to read quarterly article, I actually back then have thought about a way to summarize the summary of my article. So the summary of my article is the picture, right? So February 2023, we launched a rocket. May 2023 is much higher, right? So August last year, market was kind of like sideways, right? And then November 2023, launched to space, right? So that was the summary of the summary. So actually, the other thing that we do is webinar. So I do webinar. This is back in August 2023, right? And another way to keep in touch is through these events like this. So I do think that investors do not need to review your portfolio on a very frequent basis. Maybe every 6 months would be very good enough, right? So we do have like events like, half-yearly basis. So very important that I'm happy that you guys are here today, right, to get an update. Yep, that's all from me. Thank you.